SoFi is scheduled to report fourth quarter and full year 2024 financial results before the markets open on Monday, January 27th, 2025. That has investors asking if they should buy SoFi stock before the company announces its earnings. I'll answer that question in this video. I'll also preview what investors can expect from SoFi in the upcoming earnings release and what are the big things that are not well publicized that investors should know about and should look for when the company announces its financial results. So let's get into these details.
I want to thank The Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
One of the more interesting things that's developed with SoFi in 2024 is the company's lending business. To start 2024, SoFi told investors that the lending business would decline by at least 5 to 8% from 2023 levels. That was the forecast management originally gave to investors for 2024. But as the year moved forward, management became more and more optimistic about 2024. And so their lending business was more aggressive in 2024. And lending is more of a decision about the company. It's not about demand. I've been saying about all of these financial type companies that do lending, there's always people willing to borrow money. You never have a shortage of people willing to borrow money. And so when you're running a business like SoFi, it's a matter of your decision. Do you want to lend as much money this year versus last year? And those decisions are based on what you think the economic performance will be over the next 1, 2, and 3 years when you're doing the kind of loans that SoFi does, which is more personal loans than anything else. And so personal loans are not like mortgages, which are 30 years in duration. And so you want a longer term outlook. And these shorter term changes in economic performance don't mean as much into your management decision making about lending during the year. But when you're doing as much personal lending as SoFi does, then it does matter. If you're concerned about an economic recession, you're not going to want to do a lot of lending in that year, because if there's an economic recession, people are losing their jobs, businesses are experiencing decreasing income. If you're already working, maybe you're getting fewer hours, you're not getting as many promotions. And these are all risks to a company like SoFi, because if you're not working, that's the main reason why you won't pay your loan. If people are working as usual and they're getting raises and they're getting promotions, for the most part, they pay their loans. They don't miss a loan payment because they just don't want to pay it. They miss a loan payment in most cases because they lost their job, or there was an emergency and they didn't have enough savings to cover the emergency. So they had to use whatever they had available, and then there wasn't anything left to make loan payments. So that's why SoFi was so cautious going into 2024. They thought that the risks of a recession were pretty elevated. Interest rates had risen significantly in the previous 12 months, and so they took a cautious approach and then became more and more optimistic. When they report their 2024 results and when they report their fourth quarter results, I wouldn't be surprised if their lending revenue increased in 2024. And now here they're saying at least 100%, meaning like flat. 100% would be flat. Growth would be 105%, 108%. And so while I'm not expecting explosive growth here, I am expecting the company to deliver growth in this respect, especially because as the year progressed towards the end, the market became even more robust. It's not like economic activity slowed down in October, November, December. Actually, it was the opposite. Economic activity started to increase in October, And then in November, it really exploded, and December, it really exploded as the elections in the United States really brought out those animal spirits in financial markets, which created a big surge in stock prices, in asset valuations, in hiring from businesses. And so all of that is great news for SoFi's business in some respects, right? The downside of that was that interest rates also increased, and higher interest rates is bad news for SoFi because it owns billions and billions of dollars of loans at a certain interest rate. And when interest rates increased, those value of those loans that it has decreases because lenders would rather have lending at the higher interest rate, earning more for themselves rather than the lower interest rates. So in terms of operations, higher growth in the economy is good news for SoFi, but then it results in higher interest rates, which is bad news for SoFi. So there was that offsetting impact with SoFi. Additionally, I expect SoFi to give investors their forecast for 2025. And what I'm looking for from SoFi in 2025 is continued growth in profitability. They will report somewhere around 205 million in net income for 2024. I wouldn't be surprised if 2025 net income is up by 20, maybe even 30% in their forecast for 2025. The economic outlook is much better heading into 2025 than it was heading into 2024. So I expect management to be more optimistic about 2025 than they were about 2024. Those are kind of the factors I'm looking at from SoFi. Also, their financial services and tech business. Investors will want those businesses to grow faster than the lending business, which I suspect they will. I don't think the lending business will grow by all that much in 2025. If anything, I would expect maybe double digits at best, high single digits or low double digits growth for their lending business in terms of the forecast. And then hopefully they forecast much faster growth for financial services and the tech platform. You want those businesses to grow to become a larger part of its business than the lending business because the lending business is way riskier than the other segments. And the other segments, especially the tech segment and the financial services segment, are potentially more lucrative in profit margins and profitability. SoFi is now trading at a forward price to earnings of 38, which I think is a reasonable valuation for SoFi stock given its growth prospects, given its structural competitive advantage it has against legacy banks and legacy lenders, right? The brick and mortar business model, it's becoming more and more clear that those businesses are at a disadvantage. Their brick and mortar locations are holding them back rather than giving them a competitive advantage. SoFi's digital only business gives it structural advantages, to be sure. And then when I look at my discounted cash flow model, which I updated on January 15th, I should say 2025 here, it says 2024. I adjusted it because the risk-free rate is higher. When I first did my discounted cash flow model with SoFi stock, the risk-free rate was 4% because that's what the 10-year government bond was. Now the 10-year government and the 30-year government bond have increased over the last couple of months, so I adjusted the risk-free rate higher, which had the impact of lowering my intrinsic value per share from around $21 down to $19.18. Still, it's undervalued. The current market price is $15.51. So the stock is undervalued, whether you look at it on a DCF or the forward PE. Now, to answer the question whether you should buy before or after earnings, if you've been following, you know what I typically say. Split your investment into buy half before earnings and half after earnings. I make an exception to that general recommendation when I see an investment that's selling at such a low price that I think the risks are heavily weighted on one side. But in this case, I don't see that. I don't see SoFi as being way undervalued. I just think it's undervalued. I have the stock rated as a buy. But to lower your risk of a big crash, I say buy half after and half before, or buy half after the earnings come out if you don't mind the risk of missing out on the upside, if you want to eliminate the risks on the downside. So, regardless of the timing, I have the stock rated as a buy, and there's three ways you can buy it. The least riskiest way to buy it in terms of all risks, risks of the upside and risks of the downside, is to do half before and half after earnings.
Hey everyone, if you like watching my videos, then I've added a great complimentary product just for you. I've written a book that's available for sale now that highlights my 6-step investing framework. Even if you don't follow that investing framework, just reading it and knowing how I evaluate stocks will make it a lot more interesting and informative to watch my videos. I've added the link in the description below.